Good day to all, my name is Chloe, a Senior Research Analyst from iFAST. Today we shine a spotlight on the iFAST DWS Indian Equity Fund, which holds a relatively concentrated and high conviction portfolio of securities within India. India is currently the world's 5th largest economy behind Germany, Japan, China and the US. According to S&P Global, it's projected to overtake Japan and Germany to become the world's 3rd largest economy by 2030. The country also reached a notable milestone with a population of 1.4 billion people, surpassing that of China, which has held the #1 position for at least 3 centuries. Moreover, India has lately come into prominence as an important market for multinational corporations to diversify their business risks away from China and for the international supply chain. For instance, Apple and Micron are some of the prominent global companies investing significant amounts there. With time, India's role is expected to become even more prominent as tensions between US and China continue to escalate. In view of India's growth potential, we'll be looking at the iFAST DWS Indian Equity Fund, which seeks to achieve capital appreciation in the medium to long term by investing in equities issued in India or entities which have significant business interests in India. The fund is benchmarked to the MSCI India 1040 Index and aims to generate alpha via stock selection that combines the use of a bottom-up and top-down approach. While it invests primarily in large-cap companies, it has no sector bias, and the overweighting or underweighting will depend on market conditions. More specifically, the fund mainly invests in large-cap stocks at growth at reasonable price. When evaluating a business, the focus is on both qualitative issues such as your corporate governance, as well as the quality of management, as well as the quantitative issues such as your return of capital employed, as well as the cash flow generation. Overall, the fund runs a concentrated portfolio and holds approximately 30 to 40 securities. It's overweight on financials, 11.2% more relative to the benchmark, and industrials, 5% more relative to the benchmark. Looking at the fund's performance over the long term, we note that it has done decently well against its benchmark, delivering comparable annualized returns of 10.28% versus 10.2% over the past 10 years. Moreover, in the last 5 years, the iFAST DWS Indian Equity Fund has outperformed its peers, which are other Indian equity funds on our platform, and has consistently demonstrated strong performance relative to its peers during the past 5 calendar years. We also note that despite the fund having a relatively concentrated portfolio of approximately 30 to 40 securities, the fund has still managed to demonstrate resilience in down markets, having exhibited a lower maximum drawdown compared to its peers. For investors looking to tap on India's growth potential, we recommend the iFAST DWS Indian Equity Fund. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Cyrus will be sharing about Asian investment grade bonds. Over to you, Cyrus.
Hi, I'm Cyrus, Research Analyst from the iFAST research team. Today I'll be talking about the Asian investment grade bond market and how you can navigate this space with the Manulife Asia Pacific Investment Grade Bond Fund. We first look at monetary policy in Asia. For several Western markets like the US, EU and UK, inflation readings today and projected inflation forecasts by end 2023 are both way above their respective inflation targets of 2%. On the other hand, for Asia, the inflation outlook is a little more mixed. South Korea, for instance, also has higher than target inflation, but this is to a much smaller extent compared to the Western markets described earlier. China even faces concerns over deflation rather than inflation right now. Overall, this means that inflation looks better controlled in Asia, relatively speaking, and this means that central banks can also likely afford to be less aggressive too. On a bottom-up level, we also observe that Asian IG credit qualities remain stable. Using the ratio of credit upgrades to credit downgrades, we see that the ratio for Asian IG has improved substantially this year, suggesting companies continue to see improving fundamentals as a whole. Hence, we see a pretty stable outlook for Asian IG bonds as a whole. But we note that credit spreads do look fairly tight currently, likely reflecting investor demand for higher quality bonds, particularly compared to Asian high yield. This means that it is even more important to be selective in terms of credits, so investors can continue to get solid returns despite tight credit spreads. And given this extra importance of active management in the diverse Asian investment grade market, our recommendation is the Manulife Asia Pacific Investment Grade Bond Fund. This fund has distinguished itself from its peers through its good downside risk management, as well as its solid performance track record, both against its benchmark and against its peers. We think the fund managers have displayed a very strong historical track record and remain well placed for investors looking to navigate the Asian IG landscape. To get a full analysis, scan the QR code or click on the link in the description below. This wraps up the sharing for this week. Catch us again next week for more investment ideas and updates.